Imagine this. You wake up on the first of the month, check your account, and there it is, a fresh deposit from your investments. Not once a quarter, not biannually, but every single month. Sounds great, right? Well, that's exactly what these top 5 dividend-paying ETFs can do for you. In this video, I'll break down the best ETFs that not only pay monthly dividends, but also offer strong growth. But here's the catch. Not all monthly dividend ETFs are created equal. I've meticulously ranked these ETFs using 5 key factors: assets over $1 billion, a dividend yield of at least 3%, 1-year returns of 10%, 3-year returns above 20%, and impressive compound annual growth rates, also known as CAGRs. I also factor in each ETF's expense ratio as well. Oh, and don't miss the bonus ETF I'll reveal at the end. It's an up-and-comer that could dethrone the top monthly dividend ETF very soon. So which ETFs will be on the list and which one takes the top spot? Let's dive right in. Coming in at number 5 is SPHD, which is Invesco's S&P 500 High Dividend Low Volatility ETF. It may come in at number 5 on this list, but it's the clear winner for the longest named ETF of the group. SPHD offers a unique balance. With over $3 billion in assets and a dividend yield of 3.35%, this ETF focuses on high dividend, low volatility stocks from the S&P 500. Risk-averse investors love its stability, highlighted by its beta of just 0.86, less volatile than the overall market itself. Performance-wise, SPHD delivered a 26% 1-year total return and a solid 31% over 3 years, with a 3-year total return CAGR of 9.7%. Its expense ratio, a modest 0.3%, which is the lowest of this group. SPHD is a compelling choice for income-focused investors seeking stability with its high dividend stocks and low volatility, offering reduced risk during market downturn. By holding 50 diversified stocks from the S&P 500, it provides cost-effective and liquid access to a steady income stream, making it ideal for conservative investment strategies. Sliding in at number 4 is DIVO, which is Amplify's CWP Enhanced Dividend Income ETF. DIVO was also one of the top ETFs in a recent video I did that listed the best overall dividend ETFs for 2025. If you want to take a look at that, click the link above or the link in the description after you finish watching this one. DIVO is an actively managed fund that invests in high-quality, large-cap U.S. companies with a history of dividend growth. It employs a tactical covered call strategy to enhance income, and this approach aims to provide investors with a combination of dividend income, potential capital appreciation, and reduced volatility. DIVO boasts assets just under $4 billion and a nice dividend yield of 4.46%. It's delivered a 1-year return of 25% and a 3-year total return of 30%, with a 3-year CAGR of 10%. Its expense ratio is slightly higher at 0.56%, but its beta of 0.76 still keeps it less volatile than the market. DIVO is an excellent investment choice for income-focused investors seeking high dividend payouts, stability, and growth opportunities. And if you're finding this breakdown helpful, make sure to hit that like button and subscribe. I've got more content like this to help you grow your wealth and make smarter investments. And trust me, you won't want to miss the number 1 ETF on this list. It's got a yield you won't believe. Let's keep going. Landing at number 3 is FTHI, which is First Trust Buy Right Income ETF. FTHI is an actively managed fund that invests in U.S. companies and employs a buy right strategy by selling call options on the S&P 500 index. If you're wondering what a buy right strategy is, it's an approach where the fund buys stocks and sells a call option on that stock. The goal is to generate additional income from the option premium while holding the stock. While this strategy can help reduce downside risk and provide steady income, it has the potential to limit upside due to the call options and may underperform in strong bull markets. FTHI's yield is a standout at 8.29%. with $1 billion in assets just meeting our list threshold. Over the last 12 months, it's had a return of 24% and a 3-year total return of 41%, and it has a 3-year CAGR of 12.1%. At 0.75, its expense ratio is on the higher end, but it has the lowest beta in the group at 0.71. FTHI is an excellent choice for investors seeking steady income with reduced volatility. Its buy right strategy combines equity exposure with call option premiums, offering a balanced approach to income generation and risk management. Taking the number 2 spot is DHS. And no, I'm not talking about the Department of Homeland Security, but rather WisdomTree's U.S. High Dividend Fund. DHS invests in U.S. companies with high dividend yields and focuses on providing income and potential capital appreciation by targeting quality dividend-paying stocks, making it suitable for income-focused investors. DHS has $1.06 billion in assets and a dividend yield of 3.11%. Over the past year, DHS has returned 26%, and over 3 years, 37%, and they have a 3-year CAGR of 11.5%. The expense ratio for DHS is 0.38%, and it has a beta of 0.79, reflecting its stability. DHS is an attractive investment for those seeking reliable income through exposure to U.S. companies with high dividend yields. Its focus on quality, dividend-paying stocks offers potential for stable returns, making it ideal for income-oriented investors in uncertain market conditions. And taking the top spot for the best monthly dividend ETF is BITO, which is ProShares Bitcoin ETF. Now, before we get into BITO's impressive metrics, let's briefly discuss why this ETF may not be for everyone. BITO is based on Bitcoin, and because of that, it's subject to high volatility, regulatory risk, and potential for significant price swings due to the speculative nature of Bitcoin. And that's reflected in its high beta of 1.88, meaning it's almost twice as volatile as the overall market. BITO was the first U.S. Bitcoin-linked ETF offering investors exposure to Bitcoin's performance through a traditional brokerage account without having the need for a cryptocurrency exchange or wallet. It achieves this by investing in Bitcoin futures contracts rather than directly holding Bitcoin, aiming to mirror the cryptocurrency's returns. BITO has over $2.5 billion in assets, but this is where it really stands out, having a current dividend yield of 52.6%. Yes, you heard me correctly, almost 53%. Its 1-year total return is an impressive 117%, and over the last 3 years, it's up 71%. It also has the highest 3-year CAGR of the group at just under 15%. Unfortunately, it can really stand out in a poor way as well, with its expense ratio coming in a very high rate of 0.95%. And as I mentioned earlier, it can be very volatile with that beta of 1.88. I personally have investments in BITO, and it's definitely not for those who are risk averse. It has large fluctuations, but if you're investing for the long term and believe that Bitcoin will continue to grow over time, it could be an ETF investment worth considering. And finally, as I mentioned earlier, there's another ETF that pays out a monthly dividend that has become quite popular and could possibly challenge for the top spot in the near future. The only reason I didn't consider it for this list is because it's only been available for 2.5 years. And that ETF would be JEPQ, which is JP Morgan's NASDAQ Equity Premium Income ETF. JEPQ is designed to provide investors with exposure to the NASDAQ 100 while generating enhanced income through an options overlay strategy. It aims to combine growth potential from leading technology companies with a steady income stream, appealing to income-focused and growth-oriented investors alike. In comparison to the other ETFs on this list, it has the most assets by far, with over $20 billion, pointing to its popularity among investors in a short period of time. It would have the second highest dividend yield on the list at a very nice 9.3%, and has the second best 1-year total return at 29%. And since its inception in May of 2022, it has a total return of 56%, which also puts it only behind the 3-year return of BITO. JEPQ has an expense ratio of 0.35%, and it has a beta of 0.85, showing it's less volatile than the overall market. Here's a quick look at all of the top 5 ETFs and their respective metrics in regards to returns, beta, and growth. I've also added JEPQ on here as well, so you can compare it with the others on the list. And there you have it, the top 5 monthly dividend ETFs, as well as JEPQ as a bonus pick. Let me know in the comments, are you currently invested in any of these ETFs? Or do you prefer a different ETF paying a monthly dividend? If you're interested in more of my investment content, I've linked some of my other videos here for you to explore. As always, thanks for watching and hanging around till the end. Don't forget to like the video and subscribe so you don't miss out on any new content. I'm here to make content focused on your money and how to manage it best. See you in the next one.